In our top business story, falling transport costs as a result of lower gasoline prices in the UAE drove down Dubai's inflation rate to 1.9% in January. That's according to new figures. The Dubai Statistics Centre released its January consumer price data for the Emirate on Tuesday, which showed that transport cost inflation, which accounts for 9% of total inflation, fell 4.1% year-on-year as the UAE cut gasoline prices in line with falling global oil prices. Housing and utility costs, which account for almost 44% of consumer expenses, rose 4.4% from a year earlier in January, while food and beverage prices, which account for 11% of the basket, climbed by 3.1%. The slowdown in Dubai's inflation rate, which stood at 4.5% in January 2015, comes as growth at UAE non-oil private sector firms slows, with business conditions improving at the weakest rate since March 2012. Underpinning the slowdown last month was a relatively subdued rise in new work, which was linked in turn to a near stagnation in a new export business, according to the latest Emirates NBD UAE Purchasing Managers Index. Russia and Saudi Arabia, the world's largest oil producers, have agreed to freeze production at January levels in a bid to prevent further declines in prices, which reached 12-year lows last month. At a closed-door meeting in Doha, which also included ministers from Qatar and Venezuela, Saudi's oil minister agreed to end the OPEC policy of unrestricted pumping, which has sent prices plummeting to below $30 a barrel since June 2014 highs of $110 a barrel. The Organization of Petroleum Exporting Countries' January output at 33.1 million barrels a day was its highest ever, meaning that any impact on the oil price from the freeze is likely to be small. Russia, which is not a member of OPEC, produced 10.9 million barrels a day that month, its highest level in history. The move represents a shift away from the policy adopted at OPEC's December meeting, when the group scrapped production caps altogether. The four countries' oil ministers said that the deal would depend on other oil producers, including Iran, also agreeing to freeze production. The low oil prices has caused economic pain across the Gulf, leading governments including Saudi Arabia and the UAE to cut public spending in a bid to preserve their financial reserves. As Dubai's non-oil trade with the Commonwealth of Independent States grew from 15.5 billion dirhams in 2011 to 20.8 billion dirhams in 2014, the Dubai Chamber of Commerce and Industry has launched a new report on the GCC-CIS trade ties. Addressing a huge gathering of top CEOs and industry professionals during the first edition of the two-day CIS Global Business Forum in Dubai today, the UAE Minister of Energy, His Excellency Engineer Suhail Mohammed Faraj Al Mazrui, stated that UAE's experiences in preparing for a future beyond oil offer learning opportunities for the CIS countries, adding that UAE was quick in implementing a diversification strategy to overcome the challenges posed by the oil market volatility. The Ministry of Energy highlighted that CIS nations will have to quickly develop an independent strategy away from oil. During a discussion on finding ways to leverage the CIS-GCC relationship, experts stated that Dubai can greatly help in reviving the ancient Silk Route by building synergies between various financial markets, as it serves over 2 billion customers in the region. Officials also mentioned that the CIS region, with over 280 million people and a $2 trillion economy, has a strategic importance to investors from GCC countries.
The CIS countries going through a lot of challenges nowadays. There is devaluation of currencies. They are heavily depending on oil prices and exports of hydrocarbons. But we believe this is a very good time to showcase the opportunities in these economies, because a lot of these the governments of these countries are privatizing a lot of the companies, which can open opportunities, which is also supported with the reduction of the valuation of the currencies. We are maybe focusing in the areas where Dubai businesses have a competitive advantage, whenever it's logistics, hospitality, real estate, and that can open a lot of opportunities. Part of what we do is showcasing these countries with their opportunities, but also we are addressing the challenges.
During a panel discussion, senior government officials from the CIS nations stated that there is a huge potential in various sectors such as agribusiness, infrastructure and logistics, and as GCC countries diversify their economy, they should continue to increase their trade investments in the region. Although experts stated that the challenge for the CIS countries is to open up their economies to sector other than oil while attracting investments and technology from other regions, including the Gulf.
I think the CIS needs to open up, diversify its sources of financing, its sources of investors, and what we have seen is increasingly an interest by Asia, China in particular, but also about the UAE in this region. We at the EBRD very much would like to encourage that, support that with our financing and with our know-how of these countries. I think the Gulf sits in between what is this new Silk Road plan, this new belt that China is talking about, which is essentially a network of infrastructure and trade connections that runs east to west. But if you think, this is land routes, but it's also maritime routes, and I think Dubai is ideally placed to play a role in this, both as a financial center, as a logistics center, and as a source of investors going to this region.
Now we switch to the free-floating regime in local currency. Now it's the currency, the tenge is cheaper 2.4 times. And that means that we have labor force quite cheap. It's cheaper than in Russia, in Kyrgyzstan, even in China. If we're talking about the investment opportunities, successful business, it's all about the market. So now we have the access to the market. It's all about the costs, opportunity, competitive advantages. Now the cost is quite cheap. And this creates the opportunity for United Arab Emirates investors.
A record number of travellers passing through the capital's airport have increased sales to an all-time high at Abu Dhabi duty-free last year. Sales rose 10.3% in 2015 to 1.5 billion dirhams, with 23 million passengers using the airport due to the concurrent growth of Etihad Airways. The airline was responsible for nearly three-quarters of traffic through Abu Dhabi last year, as the hub model of transferring passengers from point A to B via Abu Dhabi has proven successful. For the retail category, growth was up 7% year-on-year to 1.07 billion dirhams. Meanwhile, food and beverages sales grew by almost 26%. The services sector rose by 15.2%, and advertising, which is a component of the services sector, showed 26.8% growth. Abu Dhabi Duty Free is preparing for the opening of Midfield Terminal by the end of next year. It said that it would award all commercial contracts for the new terminal this year.